Hello, everyone, and welcome back to another Montreal Exchange Options Education webinar. I'm David Chirizono, the Marketing Director for the Montreal Exchange, and I'll be your host for today's session. We're very pleased to have you with us as we explore what to do with expiring options, a practical session focused on the key decisions investors face as options approach expiry. Before we begin, just a quick reminder that today's session is for educational purposes only and does not constitute as investment advice. The opinions shared are those of the presenter and do not necessarily represent the views of the Montreal Exchange or its affiliates. Options involve risk and are not suitable for all investors. If you'd like to continue learning after today's webinar, I encourage you to visit the Montreal Exchange Options Education website, where you'll find tools such as the options calculator, trading simulator, and additional strategy resources. A quick reminder that you can submit your questions at any time through the Slido app. We'll address as many questions as possible during the Q&A portion at the end of the presentation. If you'd like to revisit the content of today's session, the webinar replay will be available on the Montreal Exchange website shortly after the event. So let's get into it. It's my pleasure to introduce our speaker, Chris Thom, CEO and Portfolio Manager at Moat Financial. Chris, thank you for joining us today.
Yeah, thank you. So just excited to be here and to talk about some more option trading information. We've done the covered calls, we've done cash covered puts, and now getting into sort of what to do with expiring options. This is such a key thing, key topic. So just to add to David's disclaimer, this is just for information purposes. Make sure that you do understand options and option trading and anything before you execute any trades or seek some financial advice along the way. So just to recap here, we'll go through just a quick blurb about me, a bit about Moat Financial, and then we'll get into the meat of the presentation about effectively rolling expiring puts and calls. And then we will have about 15 minutes for Q&A at the end. But as David said, it's good to get your questions in along the way. We've got people moderating those, and then we'll take them in order. So quickly about me, I've been in the business since 2008 as an advisor and a portfolio manager. One of my designations is a derivatives market specialist, which is, goes in line with the fact that we do a lot of option trading for clients. You've likely seen me on BNN, which I'm the host of the show Know Your Options, and I've done a lot of TMX events over the years. Option education is something that I think is so important, and it's really important to me to try to get the message out, to try to simplify option trading, because if it's too complicated, then people won't use them, and obviously we want people to use them more. So at the firm, we have a segregated account business where we manage clients' accounts based on their needs. We also have the Moat Active Premium Yield ETF, where we are the portfolio manager on that. So I mentioned the show, Know Your Options. The next episode is actually in about 4 hours, and it's every 2 weeks, every second Wednesday on BNN at 3 p.m. Eastern. So tune in, get some questions in. The show isn't a show without viewer questions. Mentioned that, we sort of have two sides of our business, where we do have our segregated accounts business, where we work with individual clients to build strategies and then execute those orders. But then we've moved towards also having an ETF, which is the Moat Active Premium Yield ETF. It's TSX listed. We focus mostly on selling cash covered puts that are out of the money to generate premium. And it's meant to be an income play that provides downside protection in every trade that we do. So options, as you start to learn how to use them, you sell a covered call or you sell a cash covered put, that's mostly what we're going to be focusing on, is those two sides of the option trading versus the buying. But putting a trade on is easy, right? Anyone can do it. You're in a static environment where you know what a stock is trading at, you know what the option is trading at, you put the trade on, but then obviously a big part of what happens next is waiting. So as we get closer to expiry, this is where, more decision-making needs to happen, and we need to actually, use what we know about options and use what we know about these positions that we've created in order to adapt and adjust them in order to keep the strategies running. So put on a trade, and then as we get to expiry, the option is going to be in one of two scenarios. It's either in the money or out of the money. So out of the money means that the stock has not breached that strike price. So if it's a call option, it means that the stock is below that strike. And on the put side, it means that it is above. So fairly simple concept. That's out of the money. And then in the money is when the stock has breached that strike price. So, stock's trading at 100. We sell a 110 call. Stock goes to 112. That's now $2 in the money. So these are concepts that are going to come up throughout the presentation. And so we like to make sure everyone gets a full understanding right at the start. So out of the money, we will touch on this, but the real meat of the presentation is around in the money and what to do with these positions as we get closer to expiry. So out of the money, here, this is a situation where the option is going to be worthless. So in this image here, you see the writer has sold this option, and then when you're selling out of the money calls or out of the money puts, you're initially just selling time value. So the thing with options is they are a wasting asset. So they have value based on how long that contract is going to last. We know that options are different from stocks in that they are actually a contract between two investors through the exchange, giving the buyer the right but not the obligation to buy a set number of shares for a certain price on the call side, or sell shares at the strike price by a set date. And as that date approaches, you see that the time value, as time gets lower, starts to erode. And eventually, once you get all the way to expiry, if the stock is out of the money, that thing is going to expire worthless. So for a seller, you like when things become worthless, right? This is something that I think the word worthless, sometimes people think, oh, well, that can't be good in investing. You don't want to buy a stock and then see it be worthless. But if you sell an option, you like it when it's worthless. So that's why the writer, the seller is quite happy, but the buyer or the holder here is not quite as happy because he's bought something that is eroded all the way to zero. So as the expiry passes, so if we just use the traditional third Friday of every month, that thing goes right to zero. You go to bed on Friday night. It's in your account. You wake up Monday morning and it's gone, as if it was never there. And there's a gain or a loss depending on which side of that trade you were on. So for the seller, you've got a gain. You've sold it for something. You've effectively bought it back for zero. So now we'll be looking to do that trade again. So there's not a lot of trading that we need to do in order to close that position out, because you can just leave it. So we know that as we get to expiry, if an option is out of the money, it will not exercise. Whereas if an option is in the money, which we'll touch on, it will automatically exercise. So the in the money kind of creates a little bit more urgency or a little bit more of activity that we have to do. So in the money here, if you do nothing, so say you've sold that call that we talked about before, stock was $100, you sold that 110 call, stock goes to 112, it's in the money. If it's even 1 cent in the money, it will automatically exercise. So if you don't do anything, that option will exercise and that stock will be sold at that strike price. So you go to bed Friday night, the account's got that option and the stock, and then on Monday morning you wake up and the stock is sold at that strike price. On the put side, same thing. If the stock is below that strike price and it is in the money, it will automatically exercise. So if you want that exercise to happen, so if you've sold a call and you want to sell that stock, you just do nothing. If you want to take delivery of that stock and you've sold a put, you do nothing and it will automatically exercise. The next thing that you can do is you say, okay, look, I've made this commitment to sell this stock at the strike price, but something's changed. I'm more bullish. I want to keep the stock. I just want to sort of stop this exercise from happening. You can buy that option back. So you buy that option to close. Maybe you're buying it for more than you sold it for. Maybe you're buying it for less. But your obligation to sell that stock will go away with you buying that back, buying it to close. The next thing, and this is where what we do a lot, this is a big part of what we do, is rolling the options. So that is actually going to consist of buying back to close the option that we've sold and then selling a new option in its place. So you're just rolling it forward. You're sort of pushing it out into the future. And this is, we'll really get into detail on this. So rolling short puts and calls. So remember when we talk about being short, like if you sell a covered call, you are short that option. So you're not short the stock. It's important to understand that if we're looking at a covered call situation. But if you have sold that option, it is you have a negative number of contracts in your account. You need to roll that out if you want to adjust that position. So rolling it, what is it? Then we'll talk about what is a calendar spread, what is the process, and then how about liquidity? So that's an important thing for us to talk about is the liquidity of these trades. So rolling a short put or call, what is it? It means that we're going to buy back that call or put that we've sold and then sell one that's further into the future. So remember, because when we sell options, the where we kind of make our money on these trades is selling the time value. So if we're buying something back that has limited time left in its life, and then we sell something that's further, that has more life, more time, it will therefore have more time value. We are effectively sort of kicking this obligation down the road, but maintaining that same obligation if we're keeping the strikes the same. But because we're selling something with more time value, this is going to generate a credit. So if we're doing this as part of an income strategy where we're selling a covered call or we're selling cash covered puts because we want that income, this will generate more income. So it kind of keeps the trade going rather than needing to replace it with something new. But generating that credit and doing it over and over and over, that's something that we really touch on a lot when we do these presentations, that's where this gets to be a winning strategy. If you sell a covered call once, like you're not going to make a fortune. It's that incremental trade. We always talk about it like it's base hits. You know, you're not hitting a ton of home runs selling cash covered puts or covered calls, but you're hitting a whole lot of base hits and doing it over and over. And rolling it keeps that trade going and just sort of keeps that consistency going and keeping income coming in. So when and why do we do it? So obviously we talked about, you know, if a stock is in the money and we want to keep that position going, then we need to roll it. We do still call it rolling even if an option is expiring worthless, but you're selling a new one in its place. Effectively, when an option expires worthless, you bought it back for zero. So you're just not doing it as one trade. And then we will talk about what calendar spreads are. So this is something that's really important and gets into the liquidity side of how these trades actually function. So what is a calendar spread? You know, you'll see these graphics. I'm getting, you know, a lot of use out of AI here making these things. But a calendar spread is a two-legged trade where we're going to buy back the short dated. So in this example that we'll use throughout the presentation, we're going to buy back April and then selling June. So you're going to buy one back and sell the further dated one, but you're doing them as one trade. It's a two-legged trade, so buy one and sell another, but you're doing it at one time and they go through together. So they either both go through or neither goes through. So one thing that can happen, you know, as a person starts trading options is they say, okay, I want to buy this back and sell one further in the future. If you do it as two parts, you might get filled on one half. And so say you've sold a covered call and now you had 1,000 shares and you sold 10 calls, and then you're going to move it out to the future and you try to do it as two parts, you sell 10 more calls, and then you're trying to buy back the shorter dated one in a separate transaction. You can get kind of gummed up a little bit in case you're not getting a fill. So here you actually enter this trade as, okay, I want to buy back the short dated one, sell the further dated option, and I want it for this particular credit. So the trade actually gets entered as a credit, and then you're able to adjust that based on whether or not you're getting a fill. So, you know, the example that we'll be using later, you know, say we want a $3 credit and it doesn't fill, you can drop that to $2.99, $2.98, and all of that until you get your fill, and you get filled on both. So you never end up in a bad situation where you've only done half of the trade that you're trying to do. So again, here, you know, we're talking April and June. You know, this would be a situation where if we're rolling from April to June, maybe we're buying back that shorter dated option for $10 and selling the further dated one for $14. That's going to generate a $14 credit. The thing with it, though, is we don't actually care what either side of those options fill at. If we buy one for 20 and sell the other for 24, or we buy one for 2 and sell the other for 6. We don't care what the actual nominal amounts of the either side of the trades are, as long as it gives us that $4 credit. So that's why we put this in as that credit, and it either fills or it doesn't, and we adjust accordingly. But again, it's just really important that you just understand that you're not going to get jammed up where you've only done half of the trade, and we'll touch more on how this affects liquidity. So here is a scenario. We've got someone who has sold a put, and now that stock is trading below that strike price. This investor has said, okay, I want to keep exposure to the stock, but I don't actually want to take delivery of it. So I liked being short this option. I liked generating that credit. I preferred to have the cash set aside and then the short option position rather than taking delivery. So if it's in the money, this investor needs to do something in order to prevent him from taking delivery at this time. So he's gonna roll this position, and he's gonna generate an additional credit. So when he first sold that option, he would have generated a credit, and then now we're gonna generate a further credit for more income and keep the trade going by rolling it out. So here we've got a $50 put on ABC stock that we sold for $5 back in January, so a couple of months ago. And now that stock is trading at $48. So it is now in the money. And we're sitting here, it's, obviously April expiry is not actually 2 days away. So we're kind of fast forwarding in this example. But now there's 2 days left. So sold it in January. It was out a couple of months, out about 3 months. And now there's only 2 days left. So that time value should have shrunk pretty well, close to zero. So that's why this option should be trading just over $2, because obviously 48 is $2 below 50. So there's $2 of intrinsic value. And then there will be some, a few pennies that would need to get paid to the market maker for transacting with you in order to make this trade. So we want to replace this April $50 put with the June. So we're going to kick it out 2 months. And so because we're going to be buying the one for $2 and June has more time, it will have time value in it, we can sell that one for $5. So we're going to be able to generate about a $3 credit by doing this transaction. And so one more. This is the height of my graphics capability. It's not quite that simple, okay? So we're going to have to take into account some of the spreads on either side of the option. So we got to remember the bid-ask spread. So if we look at that April option that I said would be, was $2 in the money, and I said, okay, that should be trading for a bit over $2 because there's going to be a small amount of time value that is on top of that intrinsic value. But that option, let's say it is bid 195, offered at 215. So about 5 cents of time value to that midpoint. And then the June one, we said it was about $5. So let's just say that's 495 to 515. So if we were to put this in as 2 separate trades and we were to buy at the ask for the April option and then sell at the bid for the June option, we would actually only get about a $2.80 credit. So here we are saying, okay, this is worth about $3, but now we're only getting $2.80. So that's a big difference, especially if we're doing this over and over and over. We want to make sure that we are getting as much of a credit as possible. So here we'll do it as a calendar spread. So I mentioned that we enter these as the desired credit. So, the true value of this at the midpoints would be $3, but we've got a market maker that we're transacting with, and so we need to leave a little bit on the table for them in order to, keep their business going. So we would enter this at $2.97 for our desired credit. And if it doesn't fill, then we can lower that to $2.96, $2.95, and eventually there will be enough in that trade for the market maker that they will do both sides. So even if we had to go down to $2.95 on this, that's significantly better than if we had entered this as market orders on both sides. So we're going to be doing a lot better for ourselves, generating more premium over and over and over if we're entering this as a spread. And we're also just making sure that we're not getting jammed up with one side of the trade filling and not the other. So when we enter this order, it goes in as a spread trade, and then it's, okay, we're going to buy to close April, we're going to sell to open June, and we're putting it in at that 297 desired credit. So with this short put, this would be so again here, they're just sort of adding to that, that if we don't get that desired credit, then we can adjust that down until we do, and then both sides will fill. So the benefits of doing a calendar spread is that we will receive more. We will receive more of a credit if we are doing this as compared to just doing market orders or taking out in the bid and ask on two separate trades. And we can avoid being put to stock. So, obviously there can be some transaction costs with getting assigned on stocks. So maybe we want to just keep the option trade going. And we can keep our money in money markets, so we're generating some interest. And it really just allows us to continue operating that same trade and pushing it out further and further. So the other one is on the FX side. So if we are doing it as a spread, and we can save quite a bit of money if we are going to be trading on some US options. So the example we've got for that, in the money covered call, same process. We've sold that call. The stock has gone above that strike. And, we just decided, hey, we actually like this stock. We don't want to get called away. One thing that people will often do on the call side is change that strike price. So, we talked a bit earlier about, if stock was 100, we sold a 110 call. Now the stock's at 112. Well, maybe, their business is growing. They've entered some new markets. This is a stock that we want to own, and we are effectively increasing our target price on it. You can actually enter these spread trades, to buy back the April 110 call and sell the June 115 call. And then whatever the market lines up for the credit or debit in order to do that trade. So you can actually increase that strike. So over the course of time, you can increase where you're committing to sell that stock. It's a bit less so that people will incorporate the changing of the strike on the put side. Typically on the put side, you've said, look, this is where I'm willing to get long this stock. And oftentimes, if your feelings that you actually wouldn't want to buy it at that level, you often just will step away from that stock entirely rather than buying back the put and selling a lower strike put in its place. You can do it. And that's definitely available. But in my experience in the market, rolling call options up and out, kicking that can further down the road, but moving that obligation to a higher strike price, that is something that can be quite prevalent. We also talk about, selling puts, can't do it in registered accounts, but covered calls you can. So you can do these calendar spreads on stocks that you've sold covered calls on in your RSP, TFSA, any registered account. When would we want to use one of these calendar spreads on or rolling out a covered call? We just don't want to get called away at this time. Sometimes if we are looking at a situation where, say you bought a stock at 50 and then when it got to 100, you started selling those calls, and you don't want to get called away in December on this position because you don't want to trigger a gain in that year. You can push this out further so that the gains are triggered later in a different calendar year. And then also, just keep that trade going. Just hit it. It's just like hitting another base hit and bringing in more premium to put that into your income pile. These are associated with income generating strategies, and this sort of keeps that trade going. So we got an example of rolling a covered call. So here, back in January or back in February, we sold an April $50 call when the stock was trading at $48, and we got $2 for it. So it was a bit of a tighter timeline. That's why that option was a little bit cheaper on the selling that call versus the put in the previous example. Now we've got ABC is trading at $53, and we just don't feel like getting called away at this time. So we're going to roll this out. We'll do it to June again. We're not going to trigger that capital gain, and so we roll it out to June. Similar situation here. Now the April call is, bid 295, ask is 315, so about a 20-cent wide spread. So the midpoint being 305, and then the June $50 call. So this is an in-the-money call that we're selling. Is trading at 455 to the midpoint. So here it's $3 in the money. So there's about another $1.50 of time value that is embedded in this farther dated option that we are going to be selling. So if we did it at the bid ask, we're only going to get $1.30. If we did it right at the midpoints, we'd get $1.50. But for realistic trading scenario, we would be able to put this in at a calendar spread with a desired credit of about $1.45, and that gives the market maker a nickel. And a nickel might not sound like a lot, but obviously for market makers, they're doing these transactions all day, over and over and over, and they're just picking up, a few pennies or nickels at a time. But we get to do this transaction at a better spot than if we just did it in the open market, not with a market maker. So looking at FX. So obviously, we like to focus on Canadian options, but we know that the U.S. has an options market as well, with a lot of big companies that people want exposure to. If you have a situation where you are selling puts and calls on a U.S. stock in a Canadian dollar account, like a registered account, for example, you're rolling these things. You want to make sure that you are not paying the FX on this twice. So entering as a spread trade should get you the same FX rate on both sides of the trade, which will save a lot of money in the long run. So if we've got this example here, you've got Apple, say, trading at 255. We sold an April 245 call in an RRSP and a Canadian dollar account. We don't want to get called away. We want to roll this out to June, where that June 245 call, which is $10 in the money, is trading at $14. So we can buy back the short dated one for 10. We sell the further dated option for 14. We're going to pick up that $4 in US in an additional credit. So right now, the last couple of days have been kind of wild with swings in oil prices and FX, but here we're using at 137 as the spot rate for the foreign exchange. And so in that, a person could buy US dollars for 138.5 and sell US dollars for 135.5. So if you do this as a spread trade, and we do it for that $4 credit, it's going to be about $512 Canadian in that credit at that 137. But if we're doing it where we're buying at 138.5 on the option that we're buying back, and we're selling at 135.5 on the option that we're selling, because we're not getting that same FX rate, because we didn't do it as a spread properly with the same FX, we're actually going to get about $30 less. So $30, again, if we're doing this over and over and over, in this here, it would be significantly less than that 512, about 6%. So we're going to be able to save quite a bit of money in our trading costs in the FX if we are entering these as a spread. So this is where we actually like to go kind of to the next piece here and just say, or on a lot of these big US names that Canadians really like to trade, you can make your FX side even easier by trading them on Canadian CDRs. So there are a large number of large US listed stocks that now have Canadian CDRs that are listed on the TSX and then trade options on the Montreal Exchange. So you can actually get exposure to a lot of these US companies, but doing it all in Canada, where you're not going south of the border on anything. The CDR has everything hedged back to Canadian dollars, and you don't actually have to worry about converting anything. And then the other side of it that can be a big benefit is that you know, on a lot of these bigger US names, you know, they have, you know, $500, $600 share prices. The CDRs are a lot smaller. So, you know, instead of a $950 US position, you might have a $43 Canadian dollar position. So instead of having to commit, you know, on, because each contract is 100 shares, instead of having to commit, you know, $100 and something thousand to a position, you might be able to make that more like $4,500. So it can really simplify a lot of your trading using these CDRs, which, you know, are still relatively new in the grand scheme of things, but they are getting really strong liquidity and growing, and more of them are getting listed all the time. So liquidity. So liquidity is something that people often like to point to as, you know, an issue. And, you know, I end up being kind of a great defender of Canadian options, that liquidity is better than I think some people perceive it to be. But rolling using a calendar spread will actually help improve liquidity even beyond what is already there. So if you've got a position that, say, you've sold a call and a market maker is on the other side of that trade, that market maker is not in the business of taking risk. So they have transacted with you, they've provided you with the liquidity on the other side of that trade, and then they've hedged away their risk. So if you say they've, you know, bought a call option, you know, giving them the right to buy a stock at $110, well, they've obviously hedged themselves. We don't worry too much about how it is that they've done that. But if we're going to roll that position, it's effectively for them not a new position. So if you're going to be buying back an option and selling a further dated option at that same strike on that same underlying, that liquidity is easy for a market maker to provide because they've already hedged out that risk. They are also just kicking the can down the road. So they are willing to take a tighter spread on that calendar spread than they would if they were initiating a new position. So effectively, if you have an existing position and you can almost be providing yourself with the liquidity that you require in order to roll that out, rather than setting up a new position. So liquidity is something that you can actually play a bit of a part in creating by rolling these through calendar spreads. So, you know, it's just something that's important to understand, that there's a whole lot of mechanics that happen on the other side of that trade, and you're making their life easier by rolling an existing position because they've got their risk hedged out. And in turn, you would and should get better fills throughout that process because, you know, they don't need to make as big of a spread if they are doing it in this manner. So, you know, the conclusion here, I think I might have gone a little bit quicker than it originally planned. I got a little bit too excited, but I guess it'll leave some more time for questions. You know, using calendar spreads is very important. It is a way to continue to maintain the same exposure or the same underlying position on your stocks or your short options. It will allow you to save some money on FX, but also just keep that trade going, keep generating additional premium, which is what we're all here to do. I mean, if you look at the huge growth that is out there in covered call ETFs and, you know, now some put writing ETFs, they are all about generating income for investors. And this is a way to generate even more, whether you're doing it yourself or whether you're doing it through an instrument like an ETF. You know, in the ETF, this is what they are doing in order to roll these things out. So with that, you know, I'm a bit ahead of schedule here. So hopefully there's some questions for us to get to.
Thanks very much, Chris. We'll move into the Q&A portion of today's session. Just a reminder, if anyone has questions, just please enter them into the Slido and I'll be addressing as much as we can. So let me start with question one. Price to earnings ratio. How much weight do you place on PE when you decide to roll options or let them get called away?
Yeah, so I mean, PE, that's something that we're taking a look at. You know, for us, you know, if we're getting specific on how we manage money, I mean, PE is something that's very important to us. We're value investors at heart. So, we find a value stock that we are willing to own at a certain level. If this is something that we're going to sell puts on, PE is where we start. Obviously, it's not the only metric that we look at, but we want to have companies that are trading at attractive valuations, have strong, sustainable earnings, and we're not paying too much for them. And so once we've established that position, I guess we would continue to look at PE throughout. But if something's changed with that underlying, if their earnings have declined and now all of a sudden, it was a 15 PE when we initiated, and now by the time we're rolling it, their earnings have been cut in half and it's more like a 30 PE, then that's something that we might have a look at to decide, hey, you know what, maybe we just buy back that put that we sold and step away from that position. Or if it's on the call side, we've seen, the call, the strike get reached, but not necessarily because the earnings have gone up, but because the PE has expanded out. Then that's something that we might look at. But I guess when looking at the mechanics of entering a trade or rolling something, PE is sort of external from that decision-making process. PE is more something at the onset of a trade.
Great, thanks, Chris. I have a position in Oventive. I have sold covered calls at $80 in the past. With the rise in oil prices, OVV is now trading at about the price. I wouldn't mind closing the position profitably. What is the best way to sell these shares and buy back the covered calls?
Yeah, so you can do exactly that. If you're wanting to keep the stock, then you can buy back that option. If you want to keep generating option premium, I don't have my quote system in front of me right now, so I can't give you a direct answer on this specific position. But if you want to maintain that position and keep generating premium, you buy back the one that you've sold and you sell one that is further in the future. And if you are wanting to exit that position, you can just do nothing, right? You just leave it. And if it is in the money and it goes past expiry, you don't have to do it. The market will do it for you. And exercise that option automatically. But yeah, if you said, hey, look, I'm worried that oil prices are going to decline now and this is going to fall below that strike, you can buy back the option and sell the stock in the open market to close it out. But for something like this, if it's something you've been comfortable owning for a long time and it has breached that strike, then, and you're okay selling the stock, then just hang tight and wait for the market to sell it for you.
Great. Can you speak a bit about exercising an option before expiry? Does that happen much, and why does it happen? Would you have to buy 1,000 shares of MS before expiry when in the money and before I roll it? What are the chances of that happening?
Yeah, so you know what, that's a really good question because as we know, the person who buys an option, say you buy a call, you have the right but not the obligation to buy a set number of shares for that strike price by the expiry. But you actually have the right to exercise that at any time. So the seller, you're at the whim of the other side of the trade, but whoever has bought that option, they can exercise those at any time. So if you own an option and you say, hey, I want to exercise this early, you contact your broker or wherever you trade through, and they contact the exchange, and it will get exercised. What you actually need to keep an eye on, so we were talking about rolling these options as you get close to expiry. Another thing that you actually should be keeping an eye on is ex-dividend dates. So if you've got a non-dividend paying stock, it's kind of rare that they will get exercised early on options. It can happen. Whoever buys an option, they have that right to exercise it anytime they want, and they've got their whole list of reasons as to why they might exercise it. So it can happen. But typically it'll be around ex-dividends. So if you have sold a put and then a stock is going to go ex-dividend, it is somewhat likely that whoever owns that option will exercise it early if that dividend is higher than the amount of time value that is left in the option. So if you think about that, okay, we've sold a put and we sold it for $4. And now it's in the money and there's 50 cents of time value left. So say this stock, we sold a $50 put, we sold it for $5. and it doesn't really matter what we sold it for, but now the stock's trading at 45. So it's $5 in the money, and the option is trading at 550. So if that stock is going ex-dividend and that dividend payment is 60 cents, so 10 cents more than the time value that's left in it, the chances that you get assigned are very high, because whoever has that option, they're going to get more income if they exercise it and collect that dividend. So same thing on the call side. A lot of times the day after something goes ex-dividend, it will get assigned because they want that income. So keep an eye on the ex-dividend dates, and then just keep an eye on what the amount of time value that is left, and if it exceeds what that dividend payment is. And if the time value is lower than the dividend, then the odds of getting exercised early is quite high. And if it's not, then you almost hope that it gets exercised early, because the other side of the trade is effectively giving you that free money that is within that trade. Because once an option is exercised, all of the time value goes away because the option doesn't exist anymore. So yeah, but pretty unlikely that if the time value is greater than the dividend that you'll get exercised early.
Great, thanks, Chris. I don't know if they're from two separate people. I'll kind of combine these questions. Does the Montreal Exchange allow two-legged options on trading? I could affect two-legged option trading in my Investor's Edge account for US options, but not for Canadian options. Can we get clarity on this for MX? Multi-leg is available for the US, but not for Canada. How do you simulate multi-leg on Canadian options?
Yeah, so I guess what you're describing there, that would be more of your platform issue versus MX. MX absolutely has two-legged trades and these spread trades. And so if you are using a platform, so I'm not here to advocate for any particular DIY brokerages, but if they are allowed, and so if you can only do US and not Canada, that's something you might want to speak to your provider that you are using, and maybe encourage them to increase that functionality, because MX definitely does allow that.
Do you roll out as soon as the option is in the money, or wait near expiration?
Yeah, so for us, like when we're selling options, we're selling time value. That's where we make our money, right? And so I'm more monitoring how much time value is left rather than if it's in the money or out of the money. So let's say, for example, say we sell a put on a $50 stock and the stock goes to $100. Okay, so now this put is way out of the money. The time value on that might go, we might have sold it for $1. Maybe it's 3 cents now, and there's still 2 months left. So that's something that if the time value has effectively gone to zero, then we'll buy it back and we move on to something else. Or the other side, we've sold a $50 put and now the stock has gone to $40. Well, now that option might be trading, even if there's a couple of months left, might be trading, at just over $10. So the time value has eroded effectively to zero. And so we want to be collecting that time value and maybe preventing getting assigned. So we will roll that out. So it's, what you'll find is that if you've sold an option and there's still a lot of time left and the stock has just barely breached that strike, whether it's on a put or call, doesn't really matter, there will still be a lot of time value left. And so we've set this position up, we set it up day one, and then the next thing that we need to do is wait. So if there's still time value, I want to wait and watch that erode, because the time value on an option that you've sold is a liability. And we know that liability is going to shrink over time. I don't know what's going to happen with the stock between now and when an option expires, but I do know that the time value is going to go to zero eventually. So whether it's got intrinsic value or not, that's up to the market to decide. But I know that option will have no time value later, or will have less time value as time passes. So yeah, there's no set trigger to say, okay, this is in the money, now we roll it. It's more monitoring it and waiting for that time value to erode, and then selling something new that has more time value. Because as time goes on, the time value exists in those later, longer dated options.
Rolling a call that's listed on the TSX, will you pay 2 commissions?
So that will be something that, again, will be up to your provider. I know, one in particular that does not charge to close out options. So that would be a commission on just one side, but that would be something that you would need to understand from your broker.
Which brokers offer MX Canadian two-legged option trades?
So again, I'm not in a position here where I think I can really advocate for them for one or another. Like, we don't use any online ones. Obviously, we have a professional system, but I would say it sounds like an excellent question for ChatGPT to give you a bit of a rundown. But they definitely do exist, and I think it's worth seeking out because, I think from an industry perspective, I'd like to see all of these platforms offering that, right? I want more people to trade options, and so everyone should have all the tools at their disposal. They exist, and they are available. They just need different providers to turn them on. But I'm just not here to advocate for one or another. But I would bet that AI could come up with a bit of a list for you.
Okay, last question. How many days before earnings day will the IV go up? Example, CCO. Sold April 17, 160 strike for $3.50.
Yeah, so you'll see when you sell options that straddle an earnings, you will see an elevated implied volatility, right? It just makes sense. What drives option prices? Changes them. A lot of times it's the implied volatility within that option. Where does that implied volatility come from? Well, it comes from realized volatility on the stock. Like, how much does this thing actually move around? And then it can get elevated with some uncertainty. So earnings always has uncertainty. You don't know what they're going to say. So option prices will go up. You'll definitely see as you get close. There's no hard number. It depends, per issuer and what the market decides, right? It's a market, and it's what market participants decide should happen to the prices of those options and that implied volatility. You will see heightened implied vol as you straddle an earnings. And as you get pretty close, you will see maybe a bit of an uptick of a few points on the implied volatility once people are a bit more certain of where the stock is trading now, where the stock will be trading entering into that earnings call. And then people will tend to pay a little bit more for options. So there is no kind of set schedule that, 13 days before it goes up. Like, that doesn't really exist. But you definitely do see an elevated implied vol for options that expire beyond the next earnings call.
Great. Well, actually, one more question came in. Any advice if there are any tricks to fix a bad position? Example, I buy a BMO 200 call. The stock is now 180. My OTM call is worthless as time value goes to zero. Can it be fixed, or you just suck it up and take the loss?
Unfortunately on that one, if you are buying out of the money options, whether it's puts or calls, they will expire worthless more often than not. That's just a mathematical, statistical fact. And so there is no way to correct that. I guess if you are bullish on BMO, if you felt like it was going to be good value to buy a call at 200, and now here we are, I think the stock's more like 189. Then, if you still have that same bullish sentiment, then now you can either be buying 200 calls further into the future that are now further out of the money, that should be cheaper than it was the first time that you set up that trade, or you can be lowering that strike for where you will enter that position. I mean, what I will say, so that position, it is, as you said, something that you might need to just sort of suck up here and take your lumps. Like, you are going to lose money more often than not buying out of the money options. That's just the nature of it. And that's kind of why we're on the other side of that trade, right? I don't want to have to, if you are buying options, you need to get the direction right, the timing right, and the amplitude right. So those are three things that are pretty hard. What is your benefit of that is you get leverage, right? You can make multiples of your investment. For us, we like to be on the other side of that. I don't want to try to outsmart the market. We can sell a call And, more often than not, that thing is going to expire worthless. Sometimes we'll be wrong and we'll have a bit of regret. But for us, really looking at, doing it on a basket of stocks, sometimes they'll finish in the money, sometimes they'll be out of the money. But on the aggregate, we feel like we can generate that premium. So don't have a magic wand. I can wave over this BMO position for you. But if you are bullish, then, I'd say try to look at that same position, and maybe to reduce your outlay. Then again, going back to some of these spread trades, maybe look at a bull call spread where you're buying, one call and then selling a higher strike call against that, which will cap your gains in a situation that you get that direction, timing, and amplitude right, but it'll lower your outlay and reduce your cost in the times that you don't get those three things right at the same time.
Great. So that's all the questions that we have, and that's all the time, I guess, that we have today. Chris, thank you so much for joining us again, especially directly from the TMX Market Center. And thank you all for joining us. As I mentioned earlier, a replay will be available on the website, and you can find additional educational tools on the Montreal Exchange Options Education section on our website. Thank you again, everyone, and have a great day. Thank you.
Thank you.